to the Global Investment Performance Standards, or GIPS. The first thing I want you to do with respect to GIPS is to follow this link. So this is a CFA Institute link. And here you will notice that there are three different GIPS standards. The GIPS standards for asset owners, the GIPS standards for firms, and the GIPS standards for verifiers. The focus of this reading is going to be on the GIPS standards for firms. The first thing we need to recognize is what are the GIPS standards and why were they created. And the central idea here is that different investment management firms will report their performance. And there will be a natural tendency for firms to report numbers that look good. So different firms will want to show that they are doing well. So they might use interpretations that will make their performance numbers look good. Therefore, it is necessary that we have some global standards that different investment managers follow. This way, somebody who is looking at the reported numbers will know that a certain set of standards are being followed in order to produce these performance numbers. And that's where the GIPS standards come in. We'll talk about who can claim GIPS compliance and then who benefits from GIPS compliance. In the context of GIPS, there is an important concept of composites, and this is very testable. You need to understand what is meant by composites in the GIPS context. Then we'll talk about the fundamentals of compliance. So this is the information at the start of the GIPS document. If you actually go to the website that I just mentioned and download the GIPS document, so download the GIPS document for firms, there you will see the fundamentals of compliance in the beginning. And in this reading, we will talk about those fundamentals. Then you just need to have a general idea about the various standards. Those standards will be covered in detail at level 3. At this stage, you just need to get an overview of the GIPS standards. The final part of this reading is about verification. And the idea here is that a firm might claim GIPS compliance, but then there could be a verification process as to whether the firm is actually GIPS compliant or not. So that is this final segment of the reading. Now here we talk about the GIPS standards. The GIPS standards are a practitioner-driven set of ethical principles that establish a standardized industry-wide approach for investment firms to follow in calculating and presenting their historical investment returns to prospective clients. So the key point is that the GIPS standards have to do with how investment returns are presented. The GIPS standards ensure fair representation and full disclosure of investment performance. The GIPS standards lead investment management firms to avoid misrepresentations of performance and to communicate all relevant information that prospective clients should know in order to evaluate past results. Before the GIPS standards, there were several ways in which firms might have misrepresented past information. One mechanism is to use representative accounts. So if a given firm is managing many accounts, in order to present itself in a positive light, what the firm might do is only showcase the top performing accounts and ignore the accounts that did not do so well. So the use of representative accounts is not allowed under GIPS. The next is survivorship bias. So if a firm is managing several accounts, over time, some accounts will obviously drop off or these accounts will cease to exist. Generally, this happens with accounts that are not performing so well. When the results are reported, if the results for a given period are reported, ignoring the accounts that fell off or were discontinued during this period, then the average returns will be overstated because the returns of these accounts are not being included. This concept is called survivorship bias, and we'll talk about it in detail in other parts of the curriculum. Another issue is varying time periods. So for example, if we have firm 1, which has had excellent returns over the past 3 years, this firm might report the last 3 years of performance. Firm 2 might have had good performance over the last 5 years, so this firm might report the last 5 years worth of returns. Clearly, for a prospective investor who's evaluating firm 1 and firm 2, it's hard to compare these two numbers because one firm is presenting 3 years of data, whereas the other firm is presenting performance related to 5 years. So we can summarize now why the GIPS standards were created. These standards were created to make it easier to compare different investment management firms. Without a standard, different firms would select the method which would make them look good. Now here is a segment I've taken straight from the curriculum. It identifies the major objectives of the GIPS standards. One objective is to promote investor interests and instill investor confidence. Obviously, if a firm is using the GIPS standards, that increases the confidence that investors have in this particular firm. The GIPS standards help ensure accurate and consistent data. An important aspect of GIPS is that for performance reporting, good and accurate data must be used, because if accurate data is not being used, then obviously the performance reporting will be very questionable. Another objective is to obtain worldwide acceptance of a single standard for calculating and presenting performance. Now, clearly, there will be several investors who are evaluating firms in different parts of the world, and it is very useful if these different firms use a single standard for calculating and presenting performance. This makes comparability much easier. The GIPS standards want to promote fair global competition among investment firms. Obviously, if they are following the same rules, then that is good for competition. And the final point here is that the GIPS standards want to promote industry self-regulation on a global basis. Moving now to who can claim compliance. Firms that actually manage assets can claim compliance. So the point here is that you might have some investment firms that are just giving advice. They are not actually managing assets. So those firms can't claim compliance. But if we have a firm that is actually managing the funds of its clients, this sort of a firm can claim compliance. The other key part here is that this firm should be competing with other firms for client business. Next, we have consultants. Consultants that actually manage assets can claim compliance. So this is the same point as earlier. Generally, the perception with consultants is that they are providing advice, but the advice is not binding. So in that case, the consulting company or the consultant is not supposed to claim compliance or can't claim compliance. Only consultants that are actually managing assets can claim compliance. Next, we have asset owners. Asset owners can claim compliance in the same way as firms if they compete for business. On the other hand, asset owners who do not compete for business can choose to comply with GIPS standards for asset owners. So here the point is that we will have some asset owners, let's say an endowment fund. If an endowment fund is simply managing the endowment of a given university and not competing for business, then this endowment fund should comply with the GIPS standards for asset owners. The GIPS standards for firms will not apply here. On the other hand, if we have another asset owner that has its own assets, but it is also managing the assets of other clients, then such an entity can comply with the GIPS standards for firms. And the final point is that software firms cannot claim compliance. There are several software firms that provide software related to investment management and performance reporting. Now, the software that is being provided might support GIPS reporting, but just because the software supports GIPS reporting does not mean that the software firm can claim compliance. Only firms that are actually managing the assets of external clients can claim compliance. Next, we look at how to claim compliance. Compliance is a firm-wide process that cannot be achieved on a single product or composite. So if we have a firm that has different products and different composites, the firm can't say that only this product or this composite is compliant. The compliance reporting needs to be on a firm-wide basis. Another important point is that compliance is all or none. A firm can say that it is fully compliant with GIPS. It cannot say that we are 70% or 80% compliance. A firm can't even say that we are 95% compliant. So it's all or none, in the sense that either a firm uses a specific statement to say that it is GIPS compliant, or the firm doesn't make any claim related to GIPS compliance. Who benefits from compliance? Broadly speaking, asset management firms, investors, and asset owners all benefit from compliance. With respect to asset management firms, when they comply with GIPS, this makes prospective clients feel comfortable. So obviously, if a prospective client is evaluating firm A, B, and C, and firm A and B comply with GIPS, but firm C does not, the potential client will be more comfortable with the performance reporting done by firm A and firm B. So the fact that C does not use GIPS will be a negative for this particular firm. Participation in competitive bids. There might be many situations where investment firms are competing for business, and there will be several clients, especially large institutional clients, who will require that the firms that are participating in this competitive process should be GIPS compliant. Also, as a firm becomes GIPS compliant, that leads to the firm strengthening its internal processes and internal controls. Next, we have investors or prospective clients. GIPS reporting gives these prospective clients confidence in the integrity of performance presentations of a GIPS compliant firm. It also allows investors and potential clients to compare performance presentations from different investment management firms. So even if these investment management firms are in different parts of the world, as long as they are following GIPS standards, it makes it relatively easy for prospective clients to evaluate these different investment firms. And then we have asset owners. There are several asset owners that need to report their performance to oversight bodies. Now, often this reporting needs to happen using GIPS standards, or using GIPS standards makes it easier for these asset owners to follow a standardized process of reporting performance. If an asset owner wants to evaluate the performance of funds under their own management, the GIPS standards is an effective way of doing that. And if the firm also is evaluating external managers, it's useful if the performance of internal managers as well as external managers is being evaluated using the same standard. Or if performance reporting is happening using the same standard, a firm can evaluate whether the internal managers are doing better than the external managers or the other way around. So this can also help with decision making with respect to whether or not to invest or manage one's investments internally, or whether to outsource the investment management exercise to a third-party entity. The CFA Institute wants you to actually go through the GIPS standards. So you can go to the CFA Institute website. So here is the link. And you should download the GIPS standards for firms. You can do that from this page. And the reading actually says that you should read the preface and the introduction to the Global Investment Performance Standards. There are sections here related to the history, purpose, and key concepts of GIPS. And in fact, the learning outcomes mention the key concepts of the GIPS standards. The key concepts of the GIPS standards are not given explicitly in the reading. These key concepts are in the actual GIPS document. So you should download the GIPS document and read the segment on the key concepts of the GIPS standards. To make things easier for you, I have taken an excerpt from the key concepts, and this actually covers the main points. The GIPS standards are ethical standards for investment performance presentation to ensure fair representation and full disclosure of investment performance. So this is a summary of something that we've said earlier. Another key concept is meeting the objective of fair representation and full disclosure is likely to require more than simply adhering to the minimum requirements of the GIPS standards. Firms should also adhere to the recommendations to achieve best practice in the calculation and presentation of performance. Here the point is that with GIPS standards, we have things that are required or minimum requirements, and then we have recommendations. The point being made here is that the recommendations should also be followed. Firms must comply with all applicable requirements of the GIPS standards, including any guidance statements, interpretations, and questions and answers published by CFA Institute and the GIPS standards governing bodies. The GIPS standards do not address every aspect of performance measurement and will continue to evolve over time to address additional areas of investment performance. The GIPS standards require firms to create and maintain composites for all strategies for which the firm manages segregated accounts or markets to segregated accounts. So we'll be talking about composites on the next slide. This is a very important area. The GIPS standards rely on the integrity of input data, the quality of which is critical to creating accurate performance presentations. The underlying valuations of portfolio holdings drive performance. It is essential for these and other inputs to be accurate. The GIPS standards require firms to adhere to certain calculation methodologies and to allow for comparability across firms. So the key point here is that obviously to calculate performance returns, we need data, and then we need a certain methodology for calculation. The GIPS standards want firms to ensure that the quality of data is very good, so the data needs to be accurate, and then there needs to be consistency in the calculation methodologies so that the performance reports made by different investment firms are comparable. Moving on to composites. A composite is an aggregation of one or more portfolios managed according to a similar investment mandate, objective, or strategy. So, for example, we might have a composite which is based on small cap US equity. So, all portfolios that are managed with this particular mandate would fall in a particular composite. Composites are designed to prevent firms from cherry picking. So here, a firm can't just pick a few of these small cap US equity portfolios that are doing well and ignore the small cap US equities that are not doing well. All portfolios that meet this criteria should fall under this particular composite. A composite must include all actual fee-paying discretionary portfolios managed in accordance with the same investment mandate, objective, or strategy. So this is the point I just made. The only thing additional to highlight here is the concept of discretionary portfolios. Discretionary portfolios are portfolios where the investment firm has the discretion to decide which stocks to buy and which stocks not to buy. If there is a particular client who says that they have a small cap US equity objective, but that client, for example, tells the investment firm what stocks to buy, what stocks not to buy, then that portfolio will not be considered discretionary from the perspective of the investment firm. And since that's not a discretionary account, it will not be included in the composite. And hopefully that makes sense to you. The composite is being used to report performance. That performance number is an indication of how well the investment firm is doing. If the investment firm does not have discretion, then it does not make sense to evaluate the performance results for those accounts where there is no discretion. So basically, only discretionary portfolios need to be included in the composite. The determination of which portfolios to include in the composite should be done according to a pre-established criteria, i.e. on an ex-ante basis, not after the fact. So here the process for including portfolios in a composite needs to be decided ahead of time. We can't say during a year if a given portfolio is doing well that we want to include it in a composite, or if a portfolio is not doing well, then we exclude it. The criteria needs to be set up front, and then that can't be changed randomly. A claim of compliance requires that all fee-paying discretionary accounts managed by the firm be included in at least one composite. So this helps ensure that a poor performing account is not left out. So every account that is fee-paying and discretionary must be in at least one composite, and this implies that a given fee-paying discretionary account can be in more than one composite. Now, what the CFA Institute wants you to do is read Section 3A of the GIPS standards for firms. This Section 3A deals with the requirements for composites. So here I have pulled out Section 3 from the GIPS standards, and Section 3 is composite and pooled fund maintenance. So what you can do is simply read through this. Section 3A focuses on the requirements associated with composites. Section 3B is the recommendations. So you can just browse through the recommendations, but the reading is not asking you to go over the recommendations. So I'll just read the first two for you. The firm must create composites for the firm's strategies that are managed for or offered as a segregated account. All actual fee-paying discretionary segregated accounts must be included in at least one composite. Non-discretionary portfolios must not be included in the composites. So these are the most important points. Now, you can just read through the rest, but I feel that the testability of the rest of the material is low. You can just read it to get a sense. Moving on to fundamentals of compliance. Here there are two key aspects. The first is the definition of the firm, and the second is the definition of discretion. With respect to the definition of the firm, we must adopt the broadest, most meaningful definition of the firm. The scope of this definition should include all geographical offices operating under the same brand name, regardless of the actual name of the individual investment management company. So the key point is that we need to include the most broad possible definition of the firm. If we have a given firm with 2-3 branches, but they're all following the same process and strategy, then this needs to be defined as one firm. With respect to discretion, we should establish criteria to judge which portfolios must be included in a composite, and is based on the firm's ability to implement its investment strategies. If client-imposed restrictions interfere with the implementation of the intended strategy, then the portfolio is considered non-discretionary and must not be included in a firm's composite. So essentially, if the client is dictating which stocks to buy, which stocks not to buy, then such an account will be considered non-discretionary and should not be included in the firm's composite. Now, the CFA Institute indicates that Section 1 of the standards address the fundamentals of compliance in more detail. You are not asked explicitly to read this, but I would still encourage you to just browse through this section. So we have several points under 1A, which is fundamentals of compliance requirements. And again, I mentioned that A refers to the requirements. We will also have section 1B, which is recommendations. And I'd just highlight a couple of points here. The first one is that the GIPS standards must be applied on a firm-wide basis. We've said this multiple times now, and you need to remember this key fact. Compliance must be met on a firm-wide basis and cannot be met on a composite or pool fund or portfolio basis. So we can't say that with a given investment firm that has, let's say, 3 composites, 1, 2, and 3, we can't say that composite 1 and 2 are GIPS compliant with respect to their reporting, but composite 3 is not compliant. Either the entire firm is compliant or we don't make any statement related to compliance. The firm must be defined as an investment firm, subsidiary, or division held out to the public as a distinct business entity. So here the point is that you might have a larger umbrella company under which you have firm 1 and firm 2. Even though firm 1 and firm 2 are owned by the same entity, but if they are presented to the public as separate legal entities, then it is okay for them to have their separate reporting. It's okay for them to be defined as separate firms. So the key is that as far as the way they present themselves to the investment community, if they are presented as separate legal entities, then it is okay for them to be defined as separate firms. The GIPS reporting then will happen on a firm-wide basis. So firm 1 can have its own reporting and firm 2 can have its own reporting. Moving on to verification. Firms that claim compliance with the GIPS standards are responsible for their claim of compliance and for maintaining that compliance. Once a firm claims compliance with the standards, they may voluntarily hire a third party to perform a verification. So here, what we are saying is that getting a third party to verify is not a requirement. A firm can just say on its own that it is GIPS compliant. But if a firm does hire an independent third party, that's actually a good thing, because verification provides assurance on whether the firm's policies and procedures related to composite and pool fund maintenance, as well as the calculation, presentation, and distribution of performance, have been designed in compliance with the GIPS standards and have been implemented on a firm-wide basis. Verification is performed with respect to an entire firm and not on specific composites. Verification must be performed by an independent third party. A firm cannot perform its own verification. Third-party verification brings additional credibility to a firm's claim of compliance. So clearly, if we have, let's say, 3 firms, A, B, and C, A and B claim to be GIPS compliant, C does not. This means that investors will look at A and B more favorably relative to C. And then let's say that A gets a third-party verifier to verify this GIPS compliance. So A has verification and B does not. Here, investors will look at firm A more favorably, all else equal, because a third party has verified GIPS compliance. We are done with all the segments of this reading. Now let's summarize the key points. The first is, why were the GIPS standards created? The reason is that before GIPS standards, different investment firms would report using their own process or their own method. This meant that they would try and present their performance in the best possible light, and it would be difficult for external investors to evaluate different investment firms. The GIPS standards for firms apply to entities or asset management companies that are actually managing the assets for their clients. There are several beneficiaries of the GIPS standards. The actual asset management firms are beneficiaries. The investors who need to decide between different asset management firms also benefit. And then asset owners who might be managing their own assets and or the assets of others also benefit from the GIPS standards. The concept of composites is extremely important. For an asset management company, a composite would include all discretionary fee-paying accounts that are following a particular strategy. Every single account for a given asset management firm that is fee-paying and discretionary needs to be in at least one composite. With respect to fundamentals of compliance, we talked about the definition of the firm and discretion. The definition of the firm must be as broad and meaningful as possible. And how we define whether a given account is discretionary or not also needs to be very clear. This definition cannot keep changing randomly. We need to be clear about whether a given account is discretionary or not, because only discretionary accounts are included in the composite. And finally, independent verification is not required, but it helps. A given firm can claim GIPS compliance, and remember, claiming GIPS compliance can only happen at a firm-wide basis, and a firm cannot say that we are 95% compliant. So compliance is either all or none. And once compliance is made, it is helpful if a third party verifies GIPS compliance. That is it for this reading.